we like to do is own something at 100 times earnings where the earnings can't grow. I mean, as you point out, we've got almost $100 billion. It's a $90+ billion invested in a business, we'll call it a business, where we're paying almost 100 times earnings, and it's kind of a lousy business.
It's more after tax earnings.
Yeah, so we don't like that, and we shouldn't use your money that way for a long period of time. And then the question is, are we going to be able to deploy it? And I would say that history is on our side, but it'd be more fun if the phone would ring instead of just relying on history books. And I am sure that sometime in the next 10 years, and it could be next week or it could be 9 years from now, there will be markets in which we can do intelligent things on a big scale. But it would be no fun if that happens to be 9 years off, and I don't think it will be, but just based on how humans behave and how governments behave and how the world behaves. But like I say, at a point, the burden of proof really shifts to us big time.
Yeah, the more capital intensive is the flight safety operation, because every simulator costs real money, and we will add a number of simulators each year. So flight safety, you can look at their figures before we acquired them, and it's reasonable to extrapolate those numbers out on a larger base as we go along. But flight safety's return on equity is not going to move up or down by a dramatic amount. I mean, our simulator training prices are related to the costs of the simulator, and so there's not going to be way higher returns on equity, nor should there be way lower returns on equity. There is a growth in the equity employed in the business because it is a growing business, and we're training more and more pilots every year. But that'll be a fairly steady thing. The executive jet business is in an earlier part of its development, although it's the leader in its field by far. But we're doing substantial investment spending in a place like Europe, and we'll be doing that on an accelerated pace, if anything. In the end, though, our customers end up owning the planes. So we have an investment in a core fleet of planes which supplements the customer's planes. But by its nature, it's not a capital-intensive business. We are moving around a lot of capital every day. We'll have 140 or so customer planes now, and in aggregate, just to pick a figure, that those planes are certainly worth $1.5 billion or more, and we've got $7 billion of planes on order or some number like that. But we will sell those planes to our customers. So it could be down the line that it will be a business with a very good return on capital. We'll still have an investment in the core fleet, and we'll have some facilities, hangar facilities, and that sort of thing. But our customers will have the big capital investment. I should point out they'll have a whole lot less capital investment if they own their entire plane themselves, so they will be getting a bargain as well.
Those are extraordinary companies, obviously, and they're both huge companies. They make lots of money. They earn fantastic returns on capital. They look very tough to dislodge where they have their strengths. I would not be at all surprised to see them be worth a lot more money 10 years from now, but I wouldn't want to buy either one of them. I do not get to the level of conviction that would cause me to buy them, but I sure as hell wouldn't short them either. Charlie?
Well, I think we can fairly say that other people will always understand those two companies better than we do. We have the reverse of an edge, and we're not looking for that.
Now he's going to say, isn't the same thing true in IBM?
Well, I don't think it is. I think IBM is easier to understand.
Yeah. The chances of being way wrong in IBM are probably less, at least for us, than being way wrong with Google or Apple. But that doesn't mean that the latter two companies aren't going to do, say, far better than IBM. I mean, but we wouldn't have we wouldn't have predicted what would happen with Apple 10 years ago. And it's very hard for me to predict, what will happen with the next 10 years. There's certainly, they've come up with these brilliant products. There's other people trying to come up with brilliant products, and I just don't know how to evaluate the people that are out there working either in big companies or in garages that are trying to think of something that will change the world the way they have changed it in recent years.
And what do we know about computer science?
There's no reply. Gary, in terms of capital-intensive businesses, they're just not as good if you can find an equally good business. I mean, in terms of operations that doesn't require capital. I mean, the Seas never required capital. It didn't grow, but it just doesn't. It didn't take money to expand it, and it delivered enormous sums to us. And because we own it within Berkshire, to redeploy it elsewhere didn't require a lot of tax expense, either at the corporate level or at the personal level. So you really want a business, and everybody wants a business, that doesn't take any capital to speak of and keeps growing and doesn't take more capital as it grows. Now, our utility business, our energy business requires more capital as it grows. Our railroad business, to some extent, requires more capital if it doesn't grow even. So capital-intensive businesses, by their nature, are not as good as something where people pay in advance and you don't need the capital. I mean, if you look at where the top market value is in a $30 trillion market, if you take the top 4 or 5 companies that account for maybe 4 trillion or so of that 30 trillion. Basically, they don't take much capital, and that's why they're worth a lot of money, because they make a lot of money and they don't require the money to any great extent in the business. We own some businesses like that, but it's certainly not the railroad, and it's not the energy business. They're good businesses. We love them, but if they didn't take any capital, they'd be unbelievable. But that's just what we've learned from 50 or 60 years of operating businesses, that if you can find a great business that doesn't require capital when it grows, you've really got something. And to a certain extent, because insurance uses the kind of assets we would like to own anyway, our insurance business doesn't really take capital. It requires having capital available, but we're able to invest that money largely in things we'd like to own anyway. So we're particularly well suited for the insurance business, and it's really been the most important factor in our growth over the years, although a lot of other things contribute. Greg, you were in the capital intensive business. I thought I was doing well when I bought that city service at 11. The answer is that we always prefer the businesses that earned terrific returns on capital, like a See's Candy when we bought it, or a good many of the businesses, and American Express, earns a terrific return on equity and has for a very long time. The fact that we buy a BNSF, Burlington Northern, means that essentially we can't get more money deployed in capital-light businesses at prices that make sense to us. And so we have gone into more capital-intensive businesses that are good businesses, but wouldn't it be wonderful if we could run the railroad without trains and track and tunnels and bridges and a few things? We get a decent return on the capital-intensive businesses. We bought most of them at very decent prices, and they've been run very well since we bought them. We still love a business that takes very little capital and earns high returns and continues to grow and requires very little incremental capital. We can't deploy as much money as we have in doing that, and so is the second best choice still a good choice? The answer is yes. It's not as good as the best choice. Charlie?
Well, yes, I like the aspiration of that young lady. She basically wants a royalty on the other fellow's sales. And of course, that's a very good model. And if everybody could do that, why, nobody would do anything else. The reason we're satisfied with our utility returns and our railroad returns is they're quite satisfactory. Quite satisfactory. I wish we had two more just like them. Don't you, Warren?
Yeah, definitely.
So the answer is they're good enough, and you're asking us to get perfection. If you want us to have all our money in Coke at, say, 5% of what it's now selling for.
Yeah, and a business like Apple really doesn't take much capital, but so you've got to spend a lot of money to buy businesses like that. Very few are for sale, and the answer is we have not foregone any opportunity.
The semiconductor industry is a very peculiar industry. In the semiconductor industry, you have to take all the money you've made, and with each new generation of chips, you throw in all the money you previously made. So it's compulsory reinvestment of everything if you want to stay in the game. Naturally, I hate a business like that. At Berkshire, we like a whole lot of surplus money to come in that we can do something else with. And of course, now, if you're enough ahead of it, like Taiwan Semiconductor is, that may be a good buy at these prices. It's not at all clear to me that they're not going to succeed mightily. But it's a difficult. It's a business with enormous promise for the big winner, but it's a difficult business in requiring everybody to keep increasing the bets on and on with all the money, and so it's not perfect, that semiconductor business. But remember when Intel owned the world? Intel was once the Taiwan semiconductor business of the world.
Yeah.
They invented the damn business, and they dominated it for decades. And Intel, it's not clear to me that Intel's going to have a very decent semiconductor business, getting as far behind as they are now. My answer is it's not so damn foolproof as it looked.
Even with the incentives to build plants here in the United States, like Intel is doing in Ohio?
Well, of course, that will really help. But they're borrowing the money. There's no indication the government is going to forgive the loans or something. It's not like the recent loans to business where they said, we'll loan you the money, and then it was a way of keep the money. The government is not planning to do that with these new semiconductor loans. And so, look, it's not a field where I feel I have a lot of expertise. What the hell do I know about semiconductors?
Do you worry about any conditions that the government would put on companies that end up using any of that money, with semiconductors or anything else?
Well, of course, all of that, it's deeply intertwined with government policies of both China and the United States. So I would rather have something that's more foolproof myself. But I do think Taiwan Semiconductor is the strongest semiconductor company on earth. So I am a big admirer of what they've achieved. It's just incredible what they've achieved.
I thought I was doing well when I bought that City Service at 11. The answer is that we always prefer the businesses that earn terrific returns on capital, like a See's Candy when we bought it, or a good many of the businesses, and American Express, earns a terrific return on equity and has for a very long time. The fact that that we buy a Burlington BNSF, Burlington Northern, means that essentially we can't get more money deployed in capital light businesses at prices that make sense to us. And so we have gone into more capital intensive businesses that are good businesses, but wouldn't it be wonderful if we could run the railroad without trains and track and tunnels and bridges and a few things? We get a decent return on the capital intensive businesses. We bought most of them at very decent prices, and they've been run very well since we bought them. We still love a business that takes very little capital and earns high returns and continues to grow and requires very little incremental capital. We can't deploy as much money as we have in doing that, and so is the second best choice still a good choice? The answer is yes. It's not as good as the best choice. Charlie?
Well, yes, I like the aspiration of that young lady. She basically wants a royalty on the other fellow's sales. And of course, that's a very good model. And if everybody could do that, why, nobody would do anything else. The reason we're satisfied with our utility returns and our railroad returns is they're quite satisfactory. Quite satisfactory. I wish we had two more just like them. Don't you, Warren?
Yeah, definitely.
So the answer is they're good enough, and you're asking us to get perfection. If you want us to have all our money in Coke at, say, 5% of what it's now selling for.
Yeah, and a business like Apple really doesn't take much capital, but it's still, you've got to spend a lot of money to buy businesses like that. Very few are for sale, and the answer is we have not foregone any opportunity to buy businesses that earn high returns, very high returns on equity capital, or when we could buy them at a sensible price.
There's two ways of looking at it. If you talk about the capital necessary to run the business as opposed to what we might have paid for the business. I mean, if we buy a wonderful business, you could run the Coca-Cola company, assuming you had the bottling system separate. You could run it with no capital. Now, if you buy it for $100 billion, I mean, you can look at that as your capital, or you can look at the basic capital. When we look at what's a good business, we're defining it in terms of the capital actually needed in the business. Whether it's a good investment for us depends on how much we pay for that in the end. There are a number of businesses that operate on negative capital. Carol's with Fortune magazine. You know, any of the great magazines and operate with negative capital. I mean, the subscribers pay in advance. There are no fixed assets to speak of, and the receivables are not that much. The inventory is nothing. So a magazine business, my guess is that People magazine operates, or Sports Illustrated operate with negative capital, and particularly People makes a lot of money. So there are certain businesses. Well, we had a company called Blue Chip Stamps that where we got the float ahead of time and operated with really substantial negative capital. But there are a lot of great businesses that need very, very little capital. Apple doesn't need that much capital. The best ones, of course, are the ones that get very large while needing no capital. See's is a wonderful business, needs very little capital, but we can't get people eating 10 pounds of boxed chocolates every day.
Except here.
We want to. Generally, the great consumer businesses need relatively little capital. The businesses where people pay you in advance, magazine subscriptions being a case, insurance being a case, you're using your customers' capital, and
we like those kind of businesses, but of course so does the rest of the world, so they can become very competitive in buying them. We have a business, for example, that's run wonderfully by Kathy Barron Tamraz, called Business Wire. Business Wire does not require a lot of capital. It has receivables and everything, but it is a service-type business. And many of the service-type businesses and consumer-type businesses require little capital. And when they get to be successful, they can really be something. Charlie?
I've got nothing to add, but at any rate, the formula never changes.